What's up, guys? Welcome back to another video. This video is going to be a little bit of a new type of video. If you have been around for a while, you know that I'm absolutely obsessed with the financial markets, trading, investing, you name it. I am obsessed with it. So if you're anything like me, I think you'll like this video. If not, no hard feelings, you can click away. But it's going to be a little bit more of a casual video, so grab yourself a cup of coffee, a cup of tea. I want to share with you some of the things that I am seeing go on in the markets, what could happen over the next few months in terms of fundamental analysis, and what in the broader sense is going on in the world that I think will have a large impact on our trading. So without further ado, let's get into it. I think it'll be a fun little chat. So first off, we need to take a look at interest rates, because to understand what's going on in the market, it's completely being driven by interest rates. And aside from the 2024 election in November, the US election, I think for the rest of the year, this is going to be the number one driving factor for the market. So it's like 5.5%, okay? The current rate is 5.25 to 5.5. These are record rates. Yes, it's been higher if you go back, 50 years, but these are very high. Now, to give you a little bit of context, if you're new to what's going on in the market, the Federal Reserve, obviously, since COVID, 2020, huge inflation, had to spike rates the highest in history, the fastest in history, okay? And that is typically bad for the market because it makes it more difficult for businesses to borrow. It strengthens the dollar, which typically drops stocks. And this has now been these rates have been up here for over a year now. It's been high for a while. But what you need to know is that the market was anticipating that the Federal Reserve would begin cutting interest rates as of this year. How many interest rate cuts was still up for debate, maybe 1, 2, 3, some people were even saying, but that seems like it's no longer the case. We might still see a cut this year, but the number of cuts that the market is anticipating is dropping. Now, why is this? Well, if you were subscribed to Lark Digest, which you absolutely should be, we're about to cross 25,000 subscribers. It is completely free. We're building the #1 newsletter for traders, talking about all the updates in the industry, what's going on, insider stats, helping you get smarter about trading. So you can subscribe to that down below. But last time when CPI came out, the Consumer Price Index, the inflation rate, it came out higher than expected. Now, this might sound boring, but stick with me here. It is incredibly important if you are trading for any more than an hour. If your average trade duration is more than an hour, you need to have some idea of fundamental analysis, and this is huge. I'm going to explain it very, very simply. In order for the Federal Reserve to cut interest rates, inflation needs to be closer to their target of 2%. The Federal Reserve wants inflation to be at 2%. They view it as a healthy rate of inflation. Now, it has been going down from the record highs that we have seen over the last 4 years, but all of a sudden, it is starting to tick up. It's no longer decreasing at the rate that they expected, which is very bad news, both for the Fed, because it means inflation's high, which means people are suffering. And it is also bad news for the market and stocks and all of you watching that want stocks to absolutely rip higher, because that would probably happen if interest rates were to get cut. So it is now year-over-year inflation, so it's 3.5%. Last month alone, prices rose 0.4%. That means that inflation has now been over 3% for 36 consecutive months, which is just absolutely insane. So this is giving you the picture of what's going on in the market, okay? If we are seeing a lot of a sideways action, this is Bitcoin. We can get into Bitcoin. I'm an absolutely huge fan. Don't pay attention to the unupdated chart. We're seeing a lot of sideways action across a whole bunch of pairs. You can see here, gold has not moved since early April. The S&P 500 has had a little bit of movement. We would have to actually break this down a little bit. But you can see that for a lot of things, this is the NASDAQ, not a whole lot of movement. And when we don't see movement, it's because there isn't clarity and the market needs more clarity. So this is the broader context of what is going on. Now, we are going to get very shortly, depending on when this video comes out, we will get new CPI data, and then we'll be able to determine what is going on. But really, the main market driver right now is that it is inflation, CPI, and what the Federal Reserve will do in regards to interest rates. So you 1000% need to keep an eye on that, and that's mostly what I am watching. Now, it's a complete side note, but still somewhat connected. I saw this really interesting tweet that came out when there was the annual Berkshire Hathaway meeting that was just a week or so ago. Now, check this out. Buffett is hoarding $180 billion in cash and short-term T-bills, collecting a 5.4% interest rate. every time Buffett hoards record amounts of cash as the Fed raises rates, an epic stock crash happens within the next 12 months like it did in 2000, 2008, 2020. Okay. So if you take a look at this, the amount of cash that he's holding, obviously he's right here, right at the top, and he was holding record amounts of cash in 2008, right before the great financial crisis, right before 2020, and then obviously he went on a shopping spree, here, and then again at the 2000 tech crash. So I found this very interesting. It doesn't necessarily mean anything, but it could mean something. Buffett obviously is incredible. He is the man. But so I think this is just worth paying attention to. I thought it was interesting, so I thought I would share that. Now, to bring it back to interest rates, as you can see here, Bank of Canada, very similar to the Federal Reserve in terms of what they look at. The June rate cut bets were slashed after unexpectedly strong jobs data. So inflation and jobs data are the two most important things that the Federal Reserve is going to look at. You see, if inflation is high, people are going to suffer, everything gets more expensive. And at the same time, they need to make sure that people are still employed. Now, a stronger jobs market typically suggests that the Federal Reserve can continue to maintain or even hike interest rates so that the economy doesn't overheat. And so there's these two conflicting signals right now. The Federal Reserve wants to cut rates because it's going to help the economy, but the economy is still strong right now aside from inflation still being too hot. And this back and forth is why we've seen for a couple of years now people reference Jerome Powell will be able to do the soft landing, aka to avoid a recession. So the jobs data is still looking pretty strong here, and we can see here from KPMG, stubborn inflationary pressures coming from the services sector have made the Federal Reserve's fight to get it to its 2% target much harder in recent months. So, which means that inflation in the services sector is really what's contributing to that high inflation. Okay, so really, I like to keep things simple. I hope that was simple. Interest rates, jobs market, CPI, inflation, those are really what I'm watching. So I haven't really marked up my charts. I'm recording this on a Sunday, so we can kind of take a look at what's going on. As for Bitcoin, if we want to take a quick look at Bitcoin, I am a huge believer in Bitcoin. I'm more of a new convert, I guess you could say. I started buying last year, so we've been on an absolute tear this year, and they say the idea is that Bitcoin is a very good measure for inflation. If inflation rises, people are going to flood into Bitcoin because it's finite, 21 million coins, no more can be created, and decentralized. So if you are, conservative, you most certainly might like that. So this is the daily chart. We're bouncing off of this moving average here. I think I have this set as the 100. Yeah, I think it's the 100. So a little bit there. There's a little trend line. We obviously have a very strong key level around this price right here. Not that I'm going to be taking a buy. If you guys have been around for a while, you know my trading strategy. Very simple. I like 2 or 3 confluences daily, 4-hour charts. I like to keep it super simple. I don't trade Bitcoin. I just, I'm a long-term holder, but it's always fun to look at. Let's take a look at gold, because gold actually hasn't been ranging that much. We have had a little bit of a breakout here. So obviously we have this trend line here, which we did get our third touch off of. I think a buy coming up could be interesting to look at. Got this guy here. So let's see, when I use fibs, I want to make sure that the market's respecting it. So we bounced off the 50, so I'll extend this guy. I think a buy right off this 50 key level moving average. I think this will be really great. So maybe a little buy there. Keep an eye on that. The 61 could be interesting as well. So we could kind of copy paste this guy. So definitely something that I would want to keep an eye on depending on how quickly the market hits that, the moving averages, all that good stuff. See what's going on with that. The pound Aussie. We have a ton of traders trade US 30 and the NASDAQ. It's not something that I trade, but it's definitely interesting to watch. Swiss franc yen. Yeah, the yen has also been super interesting because Japan had negative interest rates for many years, but they just reversed that policy. And so Japan's having a whole bunch of issues, especially with their birth rate, which is an interesting thing to look into. But I'm not sure exactly what the catalyst was for this. I need to kind of stay on top of things a little bit more. CAD, I don't even trade a lot of these. Pound Swiss franc is usually a good pair to trade, but you can see here, like, we're still range bound. You see for, about a month, several weeks, we're range bound, broke out, came back up. So the market is definitely looking for a catalyst. I mean, we also have 2 wars going on right now, which is a huge factor to take into consideration, especially in terms of the strength or potential weakness of the dollar. just taking a look here, the dollar has been, this is the daily. Yeah, this year the dollar has been quite strong. So we'll see if maybe if we get more drawdown down to this level, 104, maybe we could get a bounce. But I think long term, to bring it back to the big picture, I think we're going to see, you could find a tweet that I put out well over a year ago. Interest rate cuts are guaranteed. It's going to happen. The question is just when. Is it going to be this year, next year, the year after? How many cuts? But it's guaranteed, right? We are at record high interest rate levels. You can make the argument that we need this. You can make the argument that this is bad for the economy. But either way, we're going to see it. And I think when that happens, we're going to get a weaker dollar. Stocks are going to go to the moon. This is not financial advice. But then the question is, what's actually been priced in, right? The stocks have already gone to the moon. You know, we're literally sitting at 5,200 on the S&P 500, record highs. Maybe this has already been priced in. So that is for you to figure out. But all that to say, to bring it back, I love this stuff. Let me know what you think. If you have a completely different opinion, if I missed something, overlooked something, let me know. As I said, Lark Digest, we're building it to be the #1 newsletter for traders. And over time, we're putting out a ton of new data and information on fundamental analysis. We put a poll up on Twitter, and it's one of the areas that traders really want to improve on. So we're going to do that. So if you'd like to see more of these casual, kind of easygoing videos on what I'm looking at, let me know. If you made it this far, I appreciate it. We'll see you in the next one. Until then, peace.